Hey, good afternoon. We have a lot to cover this week with the market's reaction to the Russia tensions, inflation data coming out over the past week or so. And for those who are not already registered, get ready for our upcoming planning webinar here this evening, this Thursday, the 17th at 5 p.m. I'll include a link just below. So if you haven't registered already, go ahead and follow that. Kind of last chance to register here today for the event this evening at 5 p.m. Hopefully everybody enjoyed this last weekend. It was like almost, 55, 60, depending on where you were at here in the Seattle area. So hopefully you're able to enjoy the sun. I know for myself, I went golfing Sunday. We had the Waste Management Phoenix Open tournament on and the Super Bowl Sunday night. So that day was pretty nice in my book. So hopefully everybody had a great time and was able to enjoy the nice weather. Let's start out this week talking a little bit about inflation, actually maybe a lot of bit about inflation. So last week we had consumer prices up over 7.5% year over year and 0.6% month to month. Yet again, inflation data is coming in higher than expected. On top of that, we had PPI, producer price indexes, well above the expectations, coming in at 1% for January versus a 0.5% increase for the expectations. The interesting thing is, as this inflation story continues to grow and build, we are starting to see producer price, it's not starting to, we are seeing producer prices rise faster than consumer prices. So the question is, will consumer prices pick up? Will producers begin to put that on the consumer over time? Obviously, some of that has started, but not to the extent of those producer prices compared to the consumer side of the equation. So I think that, if you look at those numbers as a whole, sometimes the producers will take those on for the short run. But it looks like, we're going to be dealing with inflation. It has looked like we're going to be dealing with inflation for a while. And so although we've already begun to see this, I think that we will continue to see producers push those prices off to the consumers over the months, years to come. So I think this is going to be really important to watch, because we'll talk about retail sales here in a minute, but we had a great number there. But as prices begin to and continue to increase, look at oil, for instance, almost hitting $100 a barrel. When the other goods, the prices start to be pushed off to the consumers, generally that's going to reduce our spending over time. So that will be very, very interesting to watch. We also have a lot to deal with as far as not just, inflation and interest rates and all this stuff we've been talking about forever, but we also have kind of a more macro impact that we're watching closely now as well. We've got this tension between Russia and Ukraine that has really started to impact markets pretty significantly. A couple of weeks back, it was really all about the Fed and interest rates and what's going on there. Fast forward to late last week, so Friday last week, and the markets were down pretty big Friday, and especially as the White House started to talk more and more about their stance and what they're expecting, and what Russia may do or what they may do in reaction to Russia, any sort of Russian actions. And so what we saw Friday was the markets continue to skid, closing off the week quite a bit lower, especially again Friday in trading. There was a lot of concern over the weekend that may escalate and continue to get worse. Coming out on Monday, it looks like things are starting to settle a little bit. So we'll watch this closely and see what comes of this. But of course, that is a big consideration as far as how markets may react and on a lot of folks' minds as well. Again, on top of all this, we had oil hit very, very close to 100. Now, it pulled back a little bit as we got closer to that number. But, this is a big price per barrel. And, the question is, well, at what point does this start to impact the markets? We talked a minute ago about how inflation being pushed to consumers eventually does start to impact the economy. And the reason for that is because we don't spend as much, right? If oil costs us, I just filled up the other day, I think it was like $4.60 a gallon or something like that, right? If oil costs us $5 a gallon, and we're on some sort of fixed budget, well, the money's got to come from somewhere. And so a lot of us may give up things like going out to eat or traveling or whatever it might be in order to pay for some of those essentials like oil, for instance. So it hasn't really impacted things yet, which is very interesting, but at some point it certainly will. And so we want to pay very, very close attention to this. This is obviously where inflation starts to become a challenge. And although we've already seen these giant numbers, I think because we had so much money in the economy, it hasn't really impacted things yet, but it will. And so we want to pay very close attention to this, obviously, as the months roll on. When I say it hasn't impacted things, the reason I touch on that is because we had retail sales numbers come out this week as well. And retail sales were up 3.8% for the month. Much, much better than last month where we saw an actual decrease. But actually, this is the highest growth month we've seen in I think, 10 months or so. So good to see these numbers continue. But again, as inflation continues, and I don't see it stopping anytime soon, this is something really to watch. To wrap all this kind of into under a bow here, basically, we also had the FOMC minutes for January come out on Wednesday, and I think it is becoming very, very clear that they almost for sure, hard to say that, but they very, very likely will be raising rates in the March, once we come out in March with the March meeting. So that is becoming something that's also very much on the market's minds. It's something I think that is to some degree priced in, but whether that's a 0.25% rate hike or a 50%, 0.5% rate hike remains to be seen. This is obviously becoming a big, big challenge. The Fed is very concerned about it now, maybe a little too late, but they're concerned about it now. And so we really want to watch this. Personally, I don't know that I would agree that they'll do a 0.5% rate hike, only because historically they have been very, very slow to make these changes. I mean, here we are, right, dealing with inflation for over a year now, and they're just now raising rates. So I don't think that they will go that quick, that soon, but it is possible. But very, very likely we will see at least 0.25% of a rate hike coming up here in March. So that is factoring in all this, right? It's factoring in this inflation, these extremely high inflation numbers. It's factoring in these retail sales numbers, and it's factoring in how some of that relates to the producer side of things as well. So be very interesting to see what happens in March. And again, I think the market will try and work through that pricing over the coming month or so until that announcement is made. Coming up next week, we've got a lot of housing data and consumer confidence. Plus, as a heads up, markets are closed on Monday for President's Day for the holiday. So we will have a short week in trading here next week, but we'll see you Thursday at 3 again to catch up on housing data and consumer confidence. This week, no question of the week, because we do have our weekly webinar this evening at 5 o'clock. Again, I'm going to put the link in the comments to register. So if you haven't already done so, go ahead and do that right now. And as long as you get ahead of that 5 o'clock time, you should be pre-registered and good to go to join us this evening at 5. Have a great upcoming weekend. We'll see you next Thursday at 3 and catch you up on what has happened in the week since.